Welcome everyone to today's event, and thank you all for joining us, and thank you to the Chazen Institute for hosting this event. My name is Pierre Yared, and I'm a professor here at the business school where I've been on the faculty since 2007. And it is my pleasure and delight to introduce to you Abby Joseph Cohen, who recently joined our faculty from Goldman Sachs, where she had been a partner for many, many years and has more broadly had a long career on Wall Street, but actually starting originally at the Federal Reserve Board in Washington. She's won numerous awards and also even had a New Yorker profile with cartoon made of her and has an HBS case based on her career. And so she is here today to provide us words of wisdom on what's going on in the global economy, what can we leave behind, and what can we look forward to, both short-term and long-term. So welcome, Abby, and thank you for taking the time to be with us today. Abby, let me start off by asking you a question. What's going on right now? This morning at 8:30, we got the CPI release. Is that good news? Is it bad news? Should we be concerned? Tell us, what's going on?
So I'm delighted to be here. I'm delighted to be a relatively new member of the Columbia faculty. And in response to your question, Pierre, what's going on now? Everyone is confused. And when I say everyone, I mean everyone. Just look at the financial markets this morning, which started with positive futures before the opening. And when I last looked, all of the market indices were down at least 1 full percentage point. So investors are confused. We're seeing that volatility not just in the stock market, but also in the fixed income markets. And we're seeing it not just in the United States, but other markets as well. The other group that's confused, not surprisingly, are business people. If you do a survey right now of what business people think, based upon what they said following their fourth quarter earnings reports, about a quarter of them think that things are just fine. About 50% of them say, I'm not quite sure. And 25% say we're heading into a recession for sure. They all can't be right. Or maybe they can. We'll delve into that a little bit later in terms of maybe there are differences by industry, for example. And the other people who are confused, Pierre, to your point now, are some of the policymakers. Because the policymakers are dealing with the same data sets that we're all looking at. But the advantage that they have is one of timing and thoroughness, right? The financial markets at 8:32 this morning had already made up their minds about what that CPI report was all about. If, however, you're at the Fed thinking about whether you need to continue to raise interest rates, or if you're at the Treasury, or if you're at some of the banking authorities, you're looking at those data in a much more thorough way. You're not just looking at the headlines. So let me give you my sense of what a more thorough analysis would look like. The most recent inflation report didn't really tell us very much at all, because there wasn't much of a change from the previous month. And that really shouldn't surprise us, because typically things shouldn't change that much. Now, it's possible that reported data will jump around an awful lot, but we always need to be careful not to respond to it in a very knee-jerk kind of fashion. Now, I can go into some details if you like. So for example, used car prices were down. That's great. Airline ticket prices were down. That's great if you're planning some travel. But a few other things moved up, and moved up more than had been expected. Things like rental. But as Pierre and I have discussed on previous occasions, that rental component of CPI jumps around all over the place, depending upon what's happening to home prices. And home prices, as you know, can be very jumpy. So bottom line for me is the CPI report this morning didn't really give me new information. It confirmed what I thought was happening all along, which is that we have had a deceleration in the rate of inflation, i.e. disinflation, not deflation. Deflation is when prices actually go down. Disinflation is when the rise in prices slows down, and that's what we've had for the last several months. And I believe that that's what the data are showing us. When I take a look at things like the labor data, I think it looks great. I, for one, am delighted to see that there are so many more open jobs than there are available workers. And it doesn't bother me so much that wages are going up, because in many cases, it's a 20-year catch-up. Now, one more point, and then I'll stop. And that is, well, what kind of information are we getting from corporate reports? For those of you who kind of like really dig into that kind of stuff, because perhaps you are a novice investor, or I know some people here were on the professional side. The fourth quarter reports, in my view, should be taken with a much more than a grain of salt, a heck of a lot of salt. Why is that? Because if you go back over history and you look to see what happens in fourth quarter earnings reports in years when the stock market is already down, is that companies tend to throw in the kitchen sink. They figure it's already a lost year, and they would rather take lots of large reserves. They would rather clear the decks so they could have an easier comparison in the year ahead. And I believe that many companies did exactly that in the fourth quarter. So I didn't get that much information from those fourth quarter results. I think we'll know much more when we start to see first quarter results. There's one industry, however, that you all need to be wary of in terms of the impact on the aggregates. And no, it's not technology, it's energy. One of the largest contributors to large S&P profit margins and earnings increases in 21 and the first half of 22 were the energy companies. And now those margins have come under pressure. I asked rhetorically, is that good news or bad news? Well, it's bad news if all you're doing is looking at the headline saying, oh my goodness, S&P profit margins are now under pressure. But it's good news for all the companies that aren't energy companies. And for me, that says more about the durability of the economic expansion than anything else.
Thank you, Abby. That actually is a good segue into my next question, which is you had mentioned a little bit of the concept of heterogeneity and how different sectors have been doing, and both in the markets and in terms of employment. And I wanted to know if you could expand a little bit on that, which sectors performed best last year relative to others, and if you think about some of those different scenarios you painted in terms of how investors think, recession for sure, no recession for sure, something in between. How do you maybe see that playing out over the next year?
Yeah,
and how would you position yourself if you're like some of our students going into financial services and thinking about what's going to be a hotter area in the future?
As you well know, there were about 6 really profound questions embedded in there. And so I'm going to unfortunately answer each one at a surface level. And I'm going to start with the incredible disparity and divergence that we saw in stock market performance, not just in 2022, but before then. And one of the things that I found as a professional investor quite disturbing is just how controlling the capitalization-weighted indices became. Many investors weren't really making investment decisions. They were putting money into indexed-oriented approaches, including ETFs. And just think about the math behind that. If everyone is putting money into the same index, well, the money is going in a cap-weighted manner. So we all know that the technology stocks, 5 or 6 of them, were a lion's share of the S&P by the end of 2020. And so much of the money that went in 2021 and early 2022 went into those same 5 or 6 stocks simply because of the cap-weighted aspect of it. And so what we found in 2022 is that there was this incredible disparity, not just in the performance of the shares, but in how they were valued. And that to me is always a red flag. So for example, some of those favorite stocks, whether it was the top 5 or 6 or the top 25 that you're looking at, had higher PE ratios, higher price to sales ratios, higher valuation metrics of all sorts than did the rest of the indices. So for example, the top 6 in the S&P 500 typically had PE ratios that were triple that of the rest of the market. That to me represents something that is not sustainable. And you say, okay, well, what's going to end it? I believe we have seen some of what's going to end it. Number one, some of the technology companies have shown themselves not to be impervious to other things that are going on in the world. They have proven themselves to sometimes make mistakes. Number two, because of the poor performance of the S&P 500 in general, and many of the other indices as well, many investors, individual investors, are now saying, keep me away from those indices. If you look, for example, at the data that come from industry sources on inflows into mutual funds and ETFs, you can see that they are no longer in favor. And there is money now going in a much more calibrated manner. Sometimes it's going into the market through active managers. Sometimes individuals are making their own decisions on specific stocks that they want to own. So there really seems to have been a change in mindset, I believe, that we can pin to the second half of 2022. Now, here we are in 2023, we should be talking about, so what's really happening in the economy and what does that mean for various industries? Something that I believe that we're going to be seeing is that the divergence that also existed between the United States markets, which did so incredibly well, and other markets that paled in comparison, that has also begun to change. And it began to change in the fourth quarter of last year. Why? Because the PE ratios of markets in Europe and Asia, in some cases, were 25 or 50% lower than the PEs of the US. And so as investors decide to become a little more proactive and make specific decisions about what they want to own, valuation has become critical. And by the way, I'm going to give myself a little postscript here. I keep talking about PE ratios. I'm not a big fan of PE ratios. There are so many better ways to value securities related to things like discounted cash flow and so on, except I'm using what is, in many cases, just easy, commonly used term of PE ratio. But when I say that, normally I'm thinking about all valuation metrics combined.
If you mentioned the issue of opportunities in the market, undervaluation.
Yep.
Do you want to give us some stock tips?
When I worked at Goldman Sachs, I had an easy out. I would say the legal department hasn't cleared me to talk about anything. And my out now is I haven't prepared anything. And so I never talk about individual names that I haven't really carefully thought about. But when we take a look at what's likely to happen in the economy and where things are priced, I believe that there are opportunities in some categories that just have not been held in high regard. One example for me would be your good old-fashioned automobile companies. Everybody got so excited about Tesla, and I know that people love the cars. You take a look at their cars now versus some other cars, there's not that much of a difference in terms of what's available, and yet the PE ratio on Tesla is about triple what it is for some of the more standard companies. And some of those standard companies, recognizing that they had a lot of catch-up, have been investing very, very heavily. And so we may see a change in view as it relates to that. I mentioned that technology stocks have waxed and waned. And I would say that what we're seeing now is basically a sorting out of the technology companies that really have something special to offer on an ongoing basis. And I was thinking about this quite a bit when I was looking at the employment data over the last couple of weeks. There's so much discussion about the loss of jobs in the technology sector. Going on publicly available information through the end of last week, about 300,000 tech jobs have been lost. And those are a lot of jobs, and that is painful for the people who have lost their jobs. But you may also recall that in that month, 500,000 new jobs were created in the economy, actually 517,000. So 300,000 is painful if you're that person, if you know that person, and so on. It's not that big a number in a large industry. And the other way to look at it is that technology was one of those sectors that kept hiring and hiring throughout the pandemic. And at that time, if you listen to what the CEOs were saying, they indicated that they were hiring in advance of needing the people. They were hiring because their competitors were hiring, and they didn't want to lose the opportunity to grab some people. And I think that what we're seeing now is an adjustment that would be pretty typical in any cyclical industry in which there was overhiring because perhaps there was overconfidence in some of the newer product lines and how sustainable they would prove to be. Now, I don't want you to think that I'm not a technology fan. I am. But I also believe that for people who are thinking about making a career in this area, we're seeing a real division now between what I would call deep tech and play tech. And what do I mean by that? There's a real difference between the companies whose product line is based upon an app, and it's easy to create apps, and maybe there's not so much of a competitive advantage. And compare that to the companies that are doing incredibly deep technology, whether it's the hardware, like the semiconductor chips, whether it is the computing equipment itself, whether it is the very serious software that needs to be developed. There's a real difference in the types of companies. Now, I don't mean to suggest that there aren't some wonderful companies that have come out of the playtech area and they've been very, very successful. But as investors and as potential employees, you need to think about whether that is a one-hit wonder or whether there's some sustainability in that company. And among the things that I look at as an investor is the level of reinvestment of capital that goes into that company. Company has great profit margins. What are they doing with that money? Are they using that money to invest in growth? Or are they using it for other purposes that may not have the same sort of longevity for the company?
Going on this idea of innovation, what are the types of companies that you think are going to benefit the most from the three major bills that were passed, the Inflation Reduction Act, the CHIPS Act, and the Infrastructure Bill? Because a lot of these involve various incentive schemes for private firms, and it's probably important for our students to think about that, because those are going to be the firms that will be expanding, even if we enter a recession.
Yeah. It's a wonderful question, and something that, quite frankly, I'm struggling with. And President Biden actually addressed the dilemma in the State of the Union address, where he said, okay, these bills have been passed, the money has been appropriated, and now it's all about implementation. How are we actually going to get it implemented? And so let's go through it bit by bit. The CHIPS Act is a very interesting one to me. For those of you who have studied a little bit of the history of the semiconductor industry, and you take it back several decades, you know that most of the creativity came out of the United States. It was developed out of university research in combination with things that were developed by the Defense Department and funded by the Defense Department. And we, as a nation in the US, really dominated the business. That's not the case for the last 20 or 30 years. There are other places that have really taken the lead. Taiwan Semiconductor, for example, and the chip production that's taking place in China, for example, right now. And so when I look at the CHIPS Act, among the things I think about with regard to implementation is, will we be funding the industry groups that will really dig deep and will be able to leapfrog the kind of technology that's out there now? Or are we just looking to replicate what is available elsewhere? Because if we're looking just to replicate, I think we've already lost. I think you really do need to be able to leapfrog. The second thing we all have to recognize is how long it takes. Micron Technology, just as one example, announced that they would be building a fab in upstate New York, near Buffalo. And when asked how long will it take, 6 years to get up and running, but 10 years to be fully operational. That's not an unusual length of time because these are very complicated construction projects. By the way, Taiwan Semiconductor made similar comments because they're building a facility, I forget now if it's Arizona or New Mexico. So when I take a look at the CHIPS Act, I think it goes in the right direction. Is it the right thing to be doing? I think it is. I think it's a national security issue in part. Are we doing enough? I don't know. I don't know if you saw it, but the head of Taiwan Semiconductor apparently, when asked about it, said it's a good start, but it's just a start. Some of the other things, including in the Inflation Reduction Act, we're looking at things having to do with climate. And in the United States, I believe that the climate action will have to take place at many different levels. I'm very proud that Columbia has been so involved and so engaged in a lot of this. And some of it will take place at the very small level. Are you putting in induction induction range in your new kitchen? Are you taking advantage of one of the new heat pumps? You know, I had a home a long time ago that had a heat pump, and it was awful. All I can say is the technology has so dramatically improved that the efficiency of heat pumps is now 3 times what it used to be. And so when we're talking about who makes the investment, sometimes it's the homeowner, sometimes it's the car owner, but then of course there's also the big investment, the electric utility companies, and whether they're spending the money wisely. Are we as a nation moving to alternative energy sources so the electricity generation can work out? Let me say something obvious. You may drive an EV. Do you really know whether that's helpful to the climate? It depends upon the utility into whose power plug you've plugged your vehicle. If you have plugged into an outlet that is powered by relatively dirty energy, you haven't accomplished anything. So much is the full length of the whole energy and electricity generation chain. One of the things about infrastructure in the United States is that, like some of these other areas, we started out doing extraordinarily well, but we fell behind. We had major infrastructure spending funded by the government in the United States in 1812. You know, this is not new for us. We had enormous infrastructure spending after the Second World War and the Eisenhower administration. We had more funding in the 1960s, and then we kind of like eased up on it. Part of it has to do with the fact that some of it is funded by the federal government, much of the rest by state and local governments. And state and local governments don't have the same sort of flexibility that the federal government does to fund things on a long-term nature. Now, what do I mean by that? I think you all know that the federal government can borrow money for a very long period of time, right? And can run a budget deficit. State and local governments cannot run a budget deficit. State and local governments, there's one exception, I believe, have to balance their budget within a one-year period. And so there's always been this political calculus done by mayors and governors and county executives saying, I know we need to improve that road or that sewer system or that bridge, but why should I pay for it? It's not going to collapse when I'm the mayor or the county executive. It's going to collapse in 10 years, and it'll be somebody else's problem at that point. And so what we have basically seen is that the quality of our infrastructure in the United States has deteriorated sharply. We used to be rated typically by the civil engineers. It's sort of an A- on average. We made it all the way to a D+. That was the average. There were other areas where we definitely were Fs. We're now sort of back up to a D or C-, not where we need to be. The new infrastructure bill, I know that some people like to refer to it as the bipartisan infrastructure bill, actually didn't have very much bipartisan support. It had a few Republicans voting for it. What's fascinating to me is that much of the money is going to be going to red states, because these are, in many cases, the states and the communities that have underfunded their infrastructure spending. Not all, but there's a great example of, I think, camaraderie between President Biden and Senator McConnell, right? Senator McConnell, one of the few who supported the infrastructure bill, basically is one of the biggest beneficiaries. His state in Kentucky is getting one of the biggest infrastructure spending projects having to do with a bridge that's been in terrible need of repair for a long time. And the president and the senator had this wonderful PR event shortly after the signing of the bill, talking about the way this bridge was going to be rehabilitated. And I believe that over the next several years, there will be, I hope, an opportunity for people on both sides of the political aisle to say, this was money well spent, not just in Kentucky, but in so many of the other areas where there has been underfunding. And as a postscript to this, one of the areas that will be receiving a good deal of funding are rural areas in the United States, where the underfunding has been most pronounced, in part because they haven't had the money to spend. They've not had the money to keep bridges up, they've not had the money to keep water systems intact, and they haven't had the money to do things like build basically broadband systems. Now, we all know in a place like New York, well, there are companies that want to provide the broadband service, and they're providing our Wi-Fi, sometimes with government subsidies. Those government subsidies have not been available in many of the rural areas, particularly in farm areas of the United States. What the infrastructure bill will do is to provide that capital so that the operating companies there will finally extend their service into some of these smaller communities.
Thanks, Abby. Let's switch gears and think about Chinese reopening, the big event in the new year. How's it going so far?
Not so well. It is one of those things where I think it was obvious, at least it was obvious to many people, or should have been, that the beginning of the reopening was going to be very problematic. And the reason, of course, starts with the science and the medicine, where such a large proportion of the Chinese population was not vaccinated. And if they were vaccinated with a Sinopharm vaccine, which has something like a 30% efficacy rate, as opposed to the 80 to 95% efficacy rates of the vaccines that we're accustomed to, number one. Number two, because of the zero COVID policies, there were not that many people, at least reported, to have had COVID, which meant there wasn't that sort of immunity that one would get from actually having had COVID. And so it was not a surprise that many people have become ill. What is very disturbing to public health officials right now is nobody really knows the extent of the illness in China, because the numbers are no longer being reported. The Chinese government is not reporting either the number of cases nor the number of deaths. And the anecdotal information suggests that there has been an extraordinarily large number of deaths, particularly among people 65 and older. Maybe this was part of the calculation done by the Chinese government. I don't really know. But we are not yet through, if you will, the disruption from the initial stage of the reopening, because don't forget that aside from the older people who, like everywhere else in the world, the older generation is more likely to get seriously ill if they become infected, the younger generation in China isn't showing up for work. So they weren't showing up for work last year and the year before because the factories were closed because of the zero COVID policy. And now they're not showing up for work because they're sick. And so we are hearing stories of supply chain disruptions continuing. Now, if we take the positive view of how the reopening will ultimately go, there will be a normalization, there will be a reopening and so on. And let's just say it'll be in the second half of this year. The hope on the part of the Chinese policymakers is that with a reopening of the economy, GDP will start to move up again. You'll start to see China become, again, re-engaging in terms of supply chain and so on. But if you want to take the negative view, basically say, the last 2 or 3 years, watching the Chinese management of COVID in their country has actually been an eye-opener of a negative sort, right? And I'm going to try to be provocative here. I don't necessarily believe everything I'm about to say, but I want you to think about it. Number one, I just described what a disaster the medical situation is right now. Number two, while the Chinese supply chain was stoppered up, the world's economy didn't stop, right? Other countries in East Asia, other countries in Latin America tried to pick up the slack. Number three, a lot of the direct investment, the investment that a company makes in another country that normally would have gone to China did not. So, for example, there was a lot of FDI, foreign direct investment, that went into places like Vietnam, went into Mexico, and I can give you the list. It depends upon the industry. And the question that one should ask if you're trying to be cynical about the Chinese reopening is, now that these other companies have discovered they don't have to do the business in China, will they go back with the same level of enthusiasm? The other issue has to do with the domestic situation within China. The domestic economy has had some problems, not just because of COVID, but because of the credit stresses in real estate and so on. These have not yet been fully resolved. And so I understand that the Chinese equity market looks reasonably valued vis-a-vis others. I understand that there is enthusiasm about getting back to business and so on. But I think that the last 2 or 3 years has made other participants perhaps somewhat skeptical. And I can't say that balloons flying over North America are all that helpful either in this regard. If you look at the decisions that need to be made by companies in the United States and Europe, what we know is even pre-pandemic, many of them were becoming more cautious about doing business in China. They were disturbed about the need to work through joint ventures. They were disturbed about having to their difficulty in protecting intellectual property rights and so on. And so the last 2 or 3 years haven't helped the Chinese image, if you will, in the global business community.
Thank you.
Was that gloomy enough?
I'm going to get
All right.
slightly maybe gloomier, perhaps. The Ukraine situation and how that's unfolding. What do you think were some surprises about how it unfolded last year? And can we learn anything from that looking forward? There was a big fear at the time about the impact on commodity prices, on energy prices.
Right.
What do you make of what we experienced, and are we out of the woods?
Yeah. I wish I knew. I'm going to begin my response by saying I'm not a military analyst. I'm not a foreign policy analyst. I'm an economist and a markets analyst. And one of the things that was a surprise last year and early this year has been that the disruption to commodity markets has not been quite as severe as we had expected. But let's be careful about that. The disruption to energy markets was extremely severe, but it has lessened in part because supplies have come on from other places and because it's been warmer than normal, right? If Europe had had as cold a winter as would normally be expected, energy prices would be notably higher than they are right now. If Israeli natural gas had not been available to the places around the Mediterranean that the Russians would normally provide to, things would not be quite so good. What I worry about is we all forget to talk about the food crisis. You know, in the US, we're blessed with ample food and very reasonably priced food relative to income levels. And if one more person complains about the price of eggs, I'm going to scream. Eggs are still extremely inexpensive as a source of protein. But if you look around the world, in the Gulf region, in Africa, in poor places around the world, food prices have moved notably higher. And if you're talking about a place like India, where their CPI has food at something like 60% of the total, you know, what is it here? 15%? You know, and much of that is because we're eating out. You know, food is not that large a component of the household budget in wealthy places, but it is in poor places. And the inability to harvest the grain in Ukraine, to ship it out and so on, really did have damaging effects. The fortunate thing is that there were alternatives found, right? So grain from North America, grain from South America, and so on. And I also have to say that the blockade of Russian shipments turned out not to be quite as effective as many people had originally thought. So where are we now? You know, the commodity prices, I think, will, in terms of energy, unless there is an actual pipeline disruption and so on, I think we're okay, in part because we've made it through most of the winter in the Northern Hemisphere. And the food prices still disturb me, as does the food distribution. But as a world, we seem to have, in my view, I'm concerned that we're not paying as much attention to it. You know, I'm looking at, for example, the rescue agencies that were involved in providing food to Africa during this period of time, and the way they're all now appropriately worried about the after effects of the earthquake in Turkey and Syria and so on. So, you know, there's still problems out there, but I think we got relatively lucky in terms of them not being as severe as many people had expected.
Very good. Okay, I'd love to turn it over to members of the audience if you have questions. Yes, over there.
Thank you. I'll be a little bit gloomy. Trump reelected, China invading Taiwan, Ukraine war expanding to Poland and NATO, and probably North Korea using nuclear power against South Korea and Japan. Within that scenario, which is
All four
possible,
of those things at the same time? That's
maybe not, because you can have ripple effect. You know, they want to weaken America, and if one starts, there's a possibility that things happen one at a time. That's what I'm thinking, especially if the war expands to Poland or Putin uses nuclear power, things can happen. So are the markets ready for this kind of scenario? Maybe one or two of them. Just an idea. Maybe
your
gloomy,
favorite
whatever, I'm
scenario.
sorry.
Yeah.
How's the market react?
You're not describing a black swan. You're describing black crows or something. You know, some raptor. You know, so that is very disturbing. You know, as I mentioned before, I'm not a military or foreign policy analyst. I'm an economics analyst, and I went on record in a newspaper interview a few weeks ago. You know, what's your year-end price target for the S&P? If I just look at the economy, if I just look at how I think corporate profits will perform and so on, I think the S&P is still going to go up from these levels, right? I have a year-end forecast, Salimi, of 4,400 for the S&P. So that's my baseline. But you are absolutely right to say there are many things that could go wrong. And what many of them have in common is that there are some bad players out there who are looking to do damage to others. You didn't mention natural disasters, for example. You're talking about invasions and so on. And I agree with you. I am concerned about that. And so one of the things that I am watching carefully, but listening to people who are far more expert than I am, as to whether some of the recent activities by the United States, by NATO, and so on, will reduce the probability of some of those events. So, for example, the recent strengthening of NATO, will that make it less likely that the Russians would try to do something in Poland? And I'm hearing that, yes, that seems unlikely. It seems unlikely they'll do anything in Moldova. And it seems that they're just trying now to save face in Ukraine, recapture the territory they lost in recent months. Not my view, but the view of people I speak to. In terms of China and Taiwan, that worries me for so many different reasons. We'll go back to the semiconductor discussion if you like. And that is the thing that I am concerned about. And I'm just going to stop with this one. What we know from centuries of world history is that when leaders feel that they're losing control, if they feel that there are problems within their country, they are much more likely to become military adventurers. And people who are specialists in this area talk about Mr. Putin doing that in Ukraine. They talk about Mr. Xi threatening, if not Taiwan, but basically some of the other things that are going on in the South China Sea and so on. So yes, I do worry about that. And I don't have a good answer for you. You asked, what would the market do? I think we'd all hide under our chairs is what we would do. I think we wouldn't know how to respond in a sensible way.
Yeah, I'd be worried about more things than my portfolio.
Exactly. You know the Animaniacs cartoon? Yeah, I won't repeat it if you don't know it. Okay. Something that tucking your head underneath your rear end when something bad goes on. But the thing that I find some hope in, not with those particular scenarios, but when things really go bad in general, just take a look at the way the US market responded to the pandemic. Find out there's a pandemic, nobody knows what it is, nobody knows how serious it is, nobody knows how to handle it. market goes down dramatically. And within literally weeks, as more information comes out and as governments respond and so on, there's kind of a relief rally where people say, okay, we sort of understand what's happening here. What's different about the scenarios you laid out is that they are not natural in nature. They're created by man, and therefore the resolution becomes much more difficult to see.
Another question?
Thank you for being so gloomy. Anybody have something fun to ask about?
Yes, in the back.
So when you're looking at historical measures of corporate profitability, corporate profits as a percentage of GDP, metrics like wealth inequality, let's say in the United States, and potential, let's say interest in alternative political ideologies, more interest in progressivism, socialism. Do you think the market's appropriately pricing some type of reversion to the mean for corporate profitability?
Very interesting question, and I think it's best answered industry by industry. Now, let me start very macro. As a macroeconomist, one would say, profits in the United States have reached record levels as a percentage of national income, and that's not the way it should be. But a macroeconomist would also say it cycles, that typically what will happen is that ratio would get pretty high, and then there would be a return of some sort to the workers. And what was so peculiar about the last 20, 25 years is that the median worker just didn't really participate in the economic vigor of the nation. And we're now seeing some of that repeat. I happen to think that's a good thing, because I think a strong middle class is what gives you a resilient economy. With regard to reversion to mean specifically, I like to look at it industry by industry, because in an economy like ours, or any economy that's dynamic and robust, there are going to be industries that come up, and there are going to be other industries that sunset. Just think in terms of, if you looked at a list of the names of the companies that were in the Dow Jones Industrial Index in the year 1900, you probably wouldn't recognize any of them. And so it's always important to compare like with like. How is this particular industry doing? Are those margins sustainable? And so on. And the other thing that also confuses the data analysis is that our economy, for the last many, many decades, has not been as open to foreign trade as it is right now. So for example, if you have in the S&P 500 companies that literally, on average, are doing 30% or more of their business outside the United States, well, should you be looking at their profits relative to US GDP if so much of their profitability is coming from the GDP in other countries? It's kind of a weird match. So I think that the direction of your question is absolutely critical and important. The specific analysis gets a little tricky.
Yes.
My name is Richardson Latortu, and I just want to start off by thanking you for your time. As we think about the next decade, and given piggybacking off your previous points on historically where rates have been and where they are now, what industries do you see driving growth specifically here in the United States over the next decade, as well as the global economy?
It's a great question, particularly against the backdrop of population changes, where in the so-called developed economies, population growth has clearly slowed, labor force growth has clearly slowed, and I think that this puts pressure on a whole host of industries. I am, at the end of the day, sort of a fan of what can happen in technology. I am a fan in terms of the way technology can be applied to some fairly staid, otherwise routine businesses. So for example, I see enormous changes coming up in things like construction. where there's greater climate sensitivity, environmental sensitivity, and so on. I think the reimagination of cities is going to prove to be an area of growth for many economies, not just the United States, but around the world. There have been other times when population growth has slowed. And very often they get followed up by periods in which population begins to grow again more rapidly. We certainly haven't seen that yet. I think that the level of economic uncertainty that so many people feel in Europe, for example, where the birth rate is at exceptionally low levels, in Japan, China, where it's now negative as well, that's really very troubling to me. And I think that the economies that grow best in this kind of environment will be the economies that, like in the past, are the ones that welcome people into their country and into the labor force. Immigrants, for example, providing appropriate educational opportunities for everybody. These are the things that raise the output of a nation and raise the productivity of a nation. And to me, that's where the opportunities are.
Yes, in the back.
Hi. So given some of the Fed's activities on interest rates and the post-pandemic structural change on how offices are used, I'm wondering if you have any opinions on the impact on lenders and securitized debt pools will be as some of these offices face obsolescence. Like given RXR recently had to give back some keys on their offices.
Yeah, from the way you asked that question, you probably have thought about it more than I have. My guess is that the securitized pools will become less and less important over time. There have been mistakes made, obviously, in things like mortgage-backed securities and so on, but they're still a very important tool. And one of the biggest issues for me has been, shall we say, lack of transparency, particularly as it relates to the leverage, the ultimate owner of some of these pools and so on. The Fed and others, I think, are really stepping up now in terms of regulatory control. And not just on securitization, but there have been a whole host of other areas where there was maybe not enough attention being paid, and now we are, if you will, suffering the consequences of it. So I think that there will always be room for that kind of securitization. It's an appropriate tool, but I just want to make sure that we all understand who's actually owning it, what the risks are, making sure that the credit ratings associated with them are appropriate. That to me would be essential for it to operate in a smooth way. Did you want to add something to that? Okay.
Yes.
You mentioned the refugees, and from the refugees and the growth that can come from bringing them in, I'm also concerned about the taxation system in this country and how you see it, the refugees affecting it, but also what's the movement of trying to move the wealth from the rich to the poor.
I didn't hear the last sentence.
Trying to move wealth from the rich to the poor.
So I'm assuming you think that's not a good idea.
No, I'm not. I'm not even astute enough to figure out which side I'm on.
Okay. There are two issues raised. One is, you said refugee. Did you mean immigrants or? Okay. And then the taxation system. Let me talk about the taxation system first. Pierre is very knowledgeable about the taxation system, so I'm going to make a couple of comments, which is that we have an incredibly inefficient taxation system, incredibly complicated. It's great for accountants, it's great for lawyers. It may not be so great for economic participants, it may not be so great for individuals, and so on. So clearly things need to be fixed and need to be adjusted. It's basically been a kludge system, right? We start with one thing, and then rather than adjusting things by a clean slate, we just keep slapping things on. We end up with some rather peculiar aspects to it. Our system is intended to be a progressive system. I believe that that is the correct way for a tax system to work in a nation such as ours, a wealthy nation. Do I find it disturbing that there are some entities, some taxpayers that are paying very low taxes? Depends why their taxes are low. You know, carried interest to me is like something that should have been taken care of, but wasn't. As a New York City resident, I sort of wish my SALT deduction wasn't limited. You know, there are lots of things I could complain about, but I'll leave it to Pierre to perhaps suggest some broader alternatives. In terms of immigrants and so on, ours is a nation that has been built by immigrants. The first immigrants, many of them here against their will, contributed mightily to the economic growth of our nation. If you look into the 20th century, you know, at various portions, you know, 10 or 15% of our nation were fresh immigrants. So this has been part of our nation. Over the 10 years prior to the start of the pandemic, about 60% of the increase, 56% of the increase in our workforce were immigrants. Think about that, right? More than half of the increase in our workforce were people who had immigrated to the United States. And these are people who come from both sides, right? I know that there's always a lot of political discussion about people who are coming from the lower end of education and income scale. The United States has been a magnet for people at the upper end as well. 65% of the people in the United States who are working PhDs in science and engineering are immigrants. Think of that, 65%. There's a very large percentage of our working physicians who are immigrants and so on. So without being a welcoming nation, I think that we would be in big trouble. We wouldn't have the skills that we need. You know, you asked specifically about people at the lower end. We need many of those people as well. Talk to some of the farmers in California who can't get enough workers. Talk to some of the restaurant owners in various cities around the country. They can't get enough workers either. And so I think we need to think about immigration reform. When George W. Bush was president, he was one of the biggest proponents of immigration reform. There was a bipartisan bill that many people thought was going to be approved, and at the end of the day, it was rejected. We need to go back to that kind of bipartisan approach, in my view, to get this resolved.
Let me ask you about one thing to worry about that we forgot to touch on, the debt ceiling. And over the summer, yeah. I'd like you to, I want to ask two questions. One is, what do you put the likelihood of an actual agreement before something bad happens? And then if that bad thing happens, what does that bad thing look like? Can Treasury, because I know you talked to a lot of folks in DC, can Treasury prioritize payments? Have they been discussing it? How would they do it? What would happen?
Yeah, I was hoping I'd get away without having to answer that question. So here we go. To me, the debt ceiling is the single biggest domestic risk. And it is a risk of an economic nature, but ultimately of a political nature. In case you've not read anything about it, you should know that the debt ceiling is really a very artificial kind of thing. There's only one other country that has it. basically what happens with the debt ceiling is that the Congress is asked to lift the amount of money that the Treasury is allowed to borrow for things which have already been approved by the Congress, right? So this is sort of like you already got approval, and then you come back later and you ask for approval again. Over the last, let's see, since 1960, according to the Treasury, the debt ceiling has been raised 79 times. 2/3 of those times have been when there has been a Republican president, and only once has there been a threat that it would not be raised. That was 2011. Those were the Tea Party Republicans. And while we never went into default, they created a lot of trouble. And you asked, what could happen? You could have the trouble before there's the default, right? So the interest rates went up. The stock market, if I recall, went down 17% or something along those lines over a very short period of time. And so even just the act of brinksmanship, getting too close to the edge, can be very damaging. In 2011, the credit rating agencies, Moody's and S&P, actually downgraded the rating of the United States of America. They lowered it a notch. I found it very, very amusing because the bond market had lowered it 2 notches the month before. So the rating agencies, as usual, were kind of late in recognizing what was going on. Do I think we're going to have that problem this time around? That is, will there be brinksmanship? Will there be damage? Will there be a rise in interest rates as a consequence of that? And the answer is yes, I do think so. And the reason is that, and again, I'm not a political analyst, but just watching what's going on in the Republican caucus and what Mr. McCarthy had to give away in order to secure his speakership, I worry that some of the people who were the holdouts at the end are among the most vociferous and vocal opponents of raising the debt ceiling limit. And that to me is very worrisome. So even if it's a game of chicken, that brinksmanship can be very damaging. Now, what can the Treasury do? The Treasury's already started. The Treasury has a whole long list of special things that they do. And what do? They basically don't make contributions. They don't make their employer contributions into the pension plans of their employees, right? So right now, the pension system of federal employees is not being funded. You say, does that really matter? Well, it matters if you happen to be a federal employee. You might want your pension to be funded. There are other things that get done. A lot of it is taking money out of one pocket, putting it in another. And the estimates that I've seen out of people in Washington who actually play these number games is that the soonest they think there could be a problem would be June. And we might be able to go as long as August or September. The big wild card right now has to do with tax receipts in April. If the tax receipts are robust, then we obviously have more running room. If the tax receipts are not robust, then June becomes the problem period. And am I worried about this? Yes, I am. I think that from an economic standpoint, the short-term disruption from a financial market standpoint, I'm having crazy conversations with people. I like the stock market moderately well. I don't like the bond market at all. And when I speak to investors, many of them are doing things like trying to guess the date when there could be a problem and not buying any Treasury securities that mature after that date. Now, that might be kind of extreme because you don't really know exactly what the date is, but there's that kind of hand-wringing going on in the investment community. There's also money that's being shifted out of potential investment in Treasury securities into things like AA corporates. And so what you may end up seeing is that the normal credit spread between the corporates and the treasuries could narrow because there's going to be increasing demand for the corporates as opposed to the treasuries. So you're going to have all of these weird things develop. These will be momentary. If you're a trader, it's kind of fun and gives you an opportunity to play some games, et cetera. But if you are an economist, or if you're somebody who is concerned about the way the United States looks to its friends around the world, and more importantly, perhaps to its adversaries around the world, having an unnecessary debate over the debt ceiling seems to me to be a dangerous game to be playing.
Abby, thank you very much for taking the time to be with us. It was delightful to be with you, and thank you for all these great insights.
Thank you all.